Well, Blackstone and Carlyle Group are poised to buy a second bank in as many months. They may have cracked the code to take over lenders as President Obama retools regulation. Let's get back to Washington, and this time with our guest, Lawrence Kaplan. He's an attorney at Paul Hastings Janofsky Walker, and he formerly worked as a lawyer with the Office of Thrift Supervision. And Mr. Kaplan, thanks so much for being with us.
Sure. Good morning.
I want to just explain to our viewers, because I believe what we're talking about is investing by these private equity firms, perhaps breaking that log jam, I suppose you could call it, as a group versus as an individual controlling shareholder. I mean, is this going to get more of a pass with regulators than they have in the last 12 months?
Well, the importance of this is private equity firms and other entities. The way the Bank Holding Company Act and the Savings and Loan Holding Company Act work is there's a look at the impermissible activities and the permissible activities. And if you control a bank, you're subject to these activities restrictions. Okay. By doing non-controlling investments as a group or a club transaction, you're not subject to the activities limitations because you're not in control. You have a minority stake. And therefore, it meets the regulatory test. Doesn't require you to engage only in permissible activities.
It meets the regulatory test, but in spirit, does it really meet what the Fed or other regulators are trying to do in limiting the activities of these private equity investors?
Well, yes and no. The important thing to remember, the Fed traditionally has a source of strength doctrine where they say if you control a bank, you have a source of strength and you're supposed to support that bank. When you look at a publicly traded company that's widely diverse shareholder base, nobody is in control there. None of those shareholders have a source of strength. So what's happening is a group of private equity firms, be it as few as you can't go over 24.9%. So 4 to 5 investors can be the equivalent of the thousands of investors in a publicly traded company. The spirit here and the activities restrictions really apply if you're in control of the bank. Okay. And the feds will regulate and they'll examine what is your structure. Do you meet their criteria for control?
Well, is there any chance, though, that the Fed could look deeper into these club deals or club structures and try to throw up some barriers to them?
Well, of course, the Fed can look in and see, do you really meet their triggers for control? And the Fed, as part of this process, does look closely of how these are structured. But at the same time, the Fed, as recently as September, they modified their minority policy statement to allow minority investors, and they allow certain interactions. It used to be a virtual separation. They've now allow you to have one director. That was something that was verboten if you had more than 15% of the equity. In September, the Fed loosened its standards somewhat, and they allow you to have up to 1/3 of the total shareholders' equity, provided no more than 15% is voting stock.
Right.
And so as a result, the Fed is allowing some more interactions, but they look closely. Do you really have a control and influence?
Okay.
If a fund... Go ahead.
Well, Mr. Kaplan, but bottom line, though, I mean, all of this will be moot unless this really type of structure is really what's going to break, as I mentioned earlier, this logjam of private equity deals. I mean, if we're not going to have any deals like that further, then there's no really point in talking about it. So do you think, though, that given all of that, does that mean that we're going to start seeing more of these private equity deals flow?
I think the answer is yes, because there's a need for capital. And if you look at the Obama administration's white paper from this week, there's an increased capital dependency for banks. And the question is, where is that capital coming from? There's a need to get that capital in. Private equity funds have the capital. The question is how we marry the two, capital with the need for the capital. And the concern is you don't want impermissible activities. The way to do it is to let them make minority investments.
Okay.
Typically,
no, go ahead.
a lot of companies don't want to be in a controlling situation. They don't want to be subject to the regulation. That doesn't mean they're not going to be under restrictions. And so when you do a minority investment, if you own more than 10%, you're frequently subject to passivity agreements that limit you. And if you violate those, there's significant consequences. But if you can live with those restrictions, and those restrictions have been loosened in September to allow a director, to allow certain conversations, to allow participation on a committee, you can be a minority shareholder, you're not subject to the activities limitations, and you're not subject to a source of strength.
Okay. Lawrence Kaplan, thanks so much for joining us on this very interesting topic on private equity funds. That was Lawrence Kaplan of Paul Hastings Janofsky and Walker.